Stocks of listed multiplex operators PVR and INOX Leisure fell sharply last week on the news of rising confirmed COVID-19 cases in the country. Let's do a three-point analysis to understand what's the road ahead for these companies. 1. Multiplexes have been resilient so far. Well, amid a widespread slowdown in the media industry recently, one segment that has stood out is that of the film exhibitors or multiplexes, which has remained a bright spot. Despite a challenging economic environment, cinemas actually managed to deliver stable advertising growth in the 9 months of FY20, as it is a preferred media for advertising with the advantage of captive audiences, which is not offered in most cases in most mediums like TV, print or the internet. Now, the two large listed players, PVR and INOX, reported a stable performance driven by healthy footfalls. The reported net profit was affected by the implementation of the Indian Accounting Standards 116, excluding which there was a profit growth. So, what makes multiplexes less vulnerable to the slowdown? Well, lipstick effect seems to be at play, a phenomena in which consumers spend money on smaller indulgences in times of recessions and in economic downturns. Online platforms also haven't dented multiplexes' business much as was widely expected or being believed. Now, the inherent volatility in the ticketing revenues of the film exhibition business is cushioned by growing ancillary revenues. For example, the share of income from food and beverages is rising fast. 2. Outbreak of COVID-19, a temporary shock. Well, given the industry's unique features, COVID-19 may become a temporary setback for all multiplexes. The epidemic will not permanently alter Indians' propensity to consume entertainment on the big screens. Also, the need of escapism will always keep the business of multiplexes vibrant despite the broader slowdown. 3. What should investors do then? Well, lower footfalls will certainly impact revenues of both these multiplexes for a quarter or two until the spreading of the virus stops, leading to a rebound in the revenue. However, during the decline, the market impact on leveraged companies will probably be quite significant. INOX, the second largest multiplex operator, is a net debt-free company as at the end of December. Now, it is well placed to withstand the temporary hit as it enjoys relatively better financial flexibility than PVR and hence higher ability to pursue organic and inorganic growth. The market leader PVR has significant debt on the books, but its debt protection metrics improved after it raised equity capital of 500 crores through QIP. Now, while we at Moneycontrol research like PVR's business fundamentals, the stock's high valuation leaves us with cold feet. Even after a fall of 25% in less than a month's time, PVR is trading at 45 times FY21 estimated earnings. Now, in a crisis time, such high valuation leaves lesser margin of safety. On the other hand, INOX also offers more comfort on the valuation front.